Welcome to the Stephens Energy Year-End Review and Outlook for 2021. We are pleased to have as our moderator today, Leslie Haynes, the Executive Editor-at-Large for Oil and Gas Investor Magazine. Leslie brings 40 years of journalism experience to our discussion. She has been with Hart Energy, the parent company of OGI, since 1983, having most recently served as Editor-in-Chief. In 2018, Leslie was recognized as one of the key women in media by Folio, a magazine industry trade group. Thank you for being here, Leslie, and moderating today's panel.
Hello, and welcome to a special presentation by Stephens Energy Investment Banking Team. Today, we're going to look at the key trends that have informed us this past year and a look ahead at what might be in store next year. My name is Leslie Haynes. I'm the Executive Editor-at-Large for Oil and Gas Investor Magazine, and I'd like to welcome everyone today. This is the third in a series of webcasts that the Stephens team has been doing, looking at all the major themes of the year: private equity, debt, financing in general, oil field services, and so on. Today, we're going to look at many different topics and hear from every member of the team, and we have some special guests as well. Let me take a moment to introduce you to everyone. First of all, we have Keith Behrens. Keith is the head of the Energy Investment Banking Team at Stephens. Next, we have Paul Moorman. Paul is also a managing director on the team. Brad Nelson is a managing director for Stephens. Holt Foster is a partner with the law firm Thompson Knight in Dallas, and he has been in the industry many years and done a lot of deals and seen a lot of things happen. And finally, we do have a special guest beaming in, which is Artem Abramov. Artem is the head of shale research at Rystad Energy, the noted consulting firm based in Oslo, Norway. With that, I'd like to get started. Keith, let's begin with you, if we might. Can you give us a bit of a high-level overview of what the team has been doing this past year?
Yeah, thanks, Leslie. Be happy to. This year, we closed 6 deals, 3, and that represents $6.3 billion in transaction volume. 3 of those in the oilfield services space, all M&A deals. 1 for a company named Intrepid, and 1 for a company named US Rail. And then we worked on a restructuring for a company named Martin Midstream. And we also worked on a restructuring for a private equity-backed upstream company named MP Resources. And then we were involved in the California Resources restructuring as well. So in total, since 2009, we're up to $48 billion in transaction volume and 168 closed deals. I think most importantly, kind of getting into next year, we have a number of deals in the pipeline. Didn't close this year, but are rolling into next year. So we were real busy on the A&D side this year, and we're carrying over several of those deals into next year. A couple of Haynesville sales, some minerals sales that we're working on. And also of note, we've been adding to our A&D group. So a lot of our competitors have been scaling back. We've been adding folks, and we're actually we have a search going on right now to add a individual in that group. Been very active in private equity. Those deals are going to roll over into next year as well. We're going to talk about one of them and get into a little more detail. We actually went to high net worth groups as a source of capital on this one particular deal versus just traditional private equity from a private equity fund. But anyway, that was it. That was it for us. A good year, and looking forward to hopefully another good year next year.
Thank you, Keith. Sounds like you've had a good year in a challenging time. Artem, I'd like to move on with you and find out from Rystad what your industry level view is of the condition of the industry right now, and what things that might influence things next year, activity next year.
Yes, thank you. Thank you, Leslie. I think it was obviously a pretty challenging year for the industry, for both E&Ps and all service companies, or suppliers. And last year was actually a transition year for E&Ps towards a new business model, because we really went from multi-year periods of very aggressive spending, systematic production growth, and very ambitious production targets towards more disciplined programs and focus on free cash flow generation. And then suddenly this year, the market downturn hit the industry. It was really unprecedented downturn, especially from the perspective of global liquid demand destruction, which peaked almost at 30 million barrels a day in April. And now many regions across the world, they're still experiencing the second wave. So the recovery in the global liquid consumption is not as rapid as many people hoped for in Q2, Q3. And we saw an immediate impact on the CapEx, on the running rate of CapEx, on the rigs, on the frac spreads. It was a collapse of around 75% in the rig counts in Q2. Frac activities stopped nearly completely at some points of time in May and June, and only in Q3 some operators started coming back in a very cautious manner. We actually saw that some private operators, they came back in a pretty opportunistic manner, a little bit faster than their public peers. And if I talk a little bit about the outlook for 2021, I would say we are seeing improving sentiment, especially among our service company clients and suppliers. Right now, we have around 120 frac spreads active in the whole country, oil and gas basins combined. Many service companies, they're currently assuming 140 to 170 spreads as an average for 2021. So there is overall expectation that we will see an upward shift in activity in Q1 2021, with majority of operators targeting maintenance capital programs. So we are not talking about any production recovery in 2021, but we are definitely not seeing any further sequential declines. So it is really flat US oil production level, somewhere in 10.5 to 11 million barrels a day range. This is something we could expect in the foreseeable future.
Thank you, Artem. I guess at this point, flat looks pretty good compared to where we've been in the past year. I'd like to turn now to some of the individual product groups within Stephens. Keith, if you could lead off and tell us about private equity investment. And is that going to be flat also, or do you see it picking up in the new year since other capital access is tough?
Yeah, and I'll cover it kind of from the upstream perspective. I think Paul might have some views on midstream and oilfield services. In the upstream space, it's been really slow. There weren't a whole lot of, new investments made by private equity funds this year. I kind of expect that to be the same going into next year. There's just a lot of funds that have older portfolio companies, and that kind of constrains them from making new investments. They really need to kind of take care of selling those older investments. So I think the opportunity and where there's going to be activity with the private equity funds is on the M&A side. There's been a lot of cramming of companies together, and I think there's some non-core assets that could be sold as a function of that. Or if the market comes back in A&D, there just could be some outright portfolio company sales. But I think until that happens, new investment activities can be a little slow amongst traditional upstream focused private equity funds.
What do you think from your perspective?
Yeah, look, and I think from an oilfield service and midstream perspective, I think it's very consistent with, how Keith positioned it. I do think private equity, will continue to return, although I think it will be at a very measured pace. To me, the biggest opportunity out there, and at some level, you got to think about it, bifurcated in two pieces. There's a lot of private equity investment that's been made over the past couple of years. So by definition, they're going to have to deal with energy, their energy investments. And then maybe I'll spend a minute about, new investments. But from an existing investment standpoint, I think the bulk of the activity is absolutely going to be from an M&A standpoint, as they're going to have to deal with those existing investments, whether it's, through an outright sale or some strategic combination, which I think is going to be the preponderance of the activity out there and where we're spending the most time. And then look, from a new platform perspective, we are seeing private equity be open to the conversation. They're just being much more picky. The other thing I do think that you'll start to see is with an absence of traditional banks and some of the traditional lending sources, as things start to ramp up, as Artem alluded to, I do think there's going to be a need for, new capital investment to fund, even if it's just rehab of existing equipment. And I do think there's a role private equity could play there as well.
Thank you. What about in the midstream? Do you have any comment there?
So on midstream, look at, up until this point, it's been a little bit more insulated, as it always is. It's just a little bit different. We're definitely seeing private equity have an interest there, but like everything else, they continue to be cautious, just from a standpoint of there's been a lot of pipelines built over the past, 2 years particularly, and with the decrease in volumes, ultimately, what does that mean? And what's the right play here? Is it crude? Is it gas? Is it a combination thereof? Obviously people have made a lot of investment in water too, which has been, sort of the crossover midstream investment. And we've been involved in a couple of situations recently where there's been a lot of private equity interest in midstream assets. I think the challenge we've seen is just, sort of the bid-ask spread that's been there in terms of what sellers want and what buyers, particularly private equity, are willing to pay. Look, they are getting creative, and there's a lot of ways to structure things which ultimately are going to allow things to go forward, but they'll just look a little bit different, in my opinion.
Brad, what do you think about the activity or involvement in the coming year of high net worth individuals or family offices as another way for companies to access capital?
Well, Leslie, I guess a couple things to mention on the front end. As you know, Stephens has been a large family office for almost 90 years. Has been operational since the early mid-30s. The family really went into the energy space, in the 50s. So we've been active for almost 7 decades, both in the upstream and midstream business. So we're a big family office. We've had a lot of family office relationships over the years. About a decade ago, we formalized that effort. So we have a full team in our Little Rock office that basically covers about 200 plus families from coast to coast. I would say average net worth of those families is probably in the $500 to $750 million range. It's been a very active platform for our investment banking firm. Since really 2018, we've closed about 12 transactions with families. I think we've raised about $2.5 billion, give or take. So it's been, a very active effort for us. But going back to your question directly, the transition, if you will, to family offices, I think is probably not going to be maybe as much as we had previously thought. And what I mean by that is really, pre-COVID, up until 2020, we've run a number of energy mandates that have, included family offices, and they've been very active. Of course, the families are seeing and reading and hearing everything that their private equity brethren are seeing, and they're just being awfully selective in this market. So I would say at the moment, out of our network, I would say 20% plus or minus families will take a look at energy investing. And as Paul alluded to earlier, I do think there's a bifurcation between midstream and infrastructure versus upstream. I think that these families are probably more interested in looking at cash flowing assets, which are more associated with midstream and infrastructure. We do feel that the upstream sector, being as capital intensive as it is, we do think that's going to be a struggle, at least here in the early part of 2020. But like everybody else, we're monitoring this closely, and we're hopeful that families kind of come back into the upstream space here in the back end of 2020.
Brad, keeping with the theory of private equity and the energy transition, there appears to be a lot of momentum in alternative energy. What are your views on that with regard to private equity investment in alternative energies and how that relates to the whole ESG momentum that we're seeing in the market?
Sure. Well, pre-COVID and pre-2020, ESG has been a constant conversation, constant theme for probably 3 to 5 years. All of the team here on the conversation and panel today, this has just been an active dialogue with all of our, private equity relationships. Of course, 2020 hit, COVID hit, and that's really stolen most of the press in 2020. But, behind the scenes, ESG is still a high priority. I would say that, every fund that we deal with is taking ESG seriously. They're either, have hired full-time consultants to advise them through that transition or process, or working with, external parties. So we know it's a high priority for them. What I would also add is that, these big funds are having to basically align themselves with their capital. They, of course, are having continuous conversations with their capital base, and we're basically calling it capital alignment. We are hearing them talk to their big investors about what they are seeking, what they're needing, what they're trying to do, and they are basically aligning their allocation of capital, accordingly. So we have found that it is somewhat of a varied response. You have, conventional energy funds that have been investing in the sector for 25 to 30 years. Some of those will, stay, investing along those lines. Then there are funds that have, multiple strategies that are probably going to include more and more renewable and ESG focused strategies. So we think it's a transition. It's been going on for a while. It will continue to happen, and it will absolutely be a priority. One question that we get are what are some of the niches that or particular verticals that some of these groups are investing in. We are seeing wind development projects, solar, geothermal, battery storage technologies, and hydrogen strategies, to name a few. And those would be direct investments. We're also seeing groups invest in those services, software, and technology that are also invested in those platforms as well. So anyway, it's been a trend that's been happening for the last 4 or 5 years, and we look for that to continue in 21.
All right, Holt, I have a question for you then. What are the legal ramifications or aspects of this so-called grand energy transition that we all do keep talking about? What's your perspective from the law angle?
The magical crystal ball. I think what we're looking at, as Brad pointed out, I think over the last 2 years or even more, there's been a big push on the ESG side. And so really what we're looking at is, what is the political environment going to have on an incremental change in that transition? And I think there's 3 things that really drive how rapidly that transition to alternative energy is going to occur. There's the regulatory regime and how that overlays. Then there's investors, as Brad pointed out, and also technological developments. When you're looking at the regulatory regime and what kind of results that's going to be, you really need to take a step back and look at the politics that drives it. And we've kind of taken one step back, and we may take one step forward, so to speak. Under the Trump administration, a lot of the planned industry requirements that were going to be put in place were put on hold. And in fact, there were a couple of approaches that the Trump administration took that were much more carbon producing company friendly. We pulled out of the Paris Accord. We went lower on regulation with respect to oil and gas as well as coal. And so a lot of the momentum, if you will, that came under the Obama administration was slowed down and took a different route under the Trump administration. Now with the impending Biden administration, I think you're going to see that from an ESG perspective, the step back, if you will, that Trump's administration undertook, you're going to see taking that step forward from Biden, and then where do we go from there? Biden's got to have this is a crystal ball issue, but Biden is walking a very thin tightrope, because on one hand, he has the far left of the Democratic Party that really is pro radical change in the green environment and really wants to move towards alternative energy. And that's Bernie, AOC, et cetera. But on the other hand, Biden is a dyed blue Wall Street Democrat, right? And so he understands what Wall Street's impact is on the economy and he is beholden to them somewhat, right, with respect to where his capital campaigns came from. And so he has to walk that line. And I think what you're going to see is Biden himself has said, look, this transition to alternative energy is not going to be radical. It's going to be gradual. And I think he said 2050 is what he hopes to have a carbon neutral United States economy. So I think in order to navigate that, he's got to take some clear, visible steps, but he also has to appease Wall Street, all of that during a COVID recession. So I think you will see us re-enter the Paris Accord, and he will acknowledge the global warming effect, which is two radically different steps than the current administration has taken. But you'll also see him fund new Green Deal programs, such as, I think, infrastructure needed for the transition, like charging stations or battery technology. And that will create investment opportunities, as Brad was pointing out. And I think when investment opportunities are created, you really start driving that transition. I think you'll also see more source-specific regulations on greenhouse gases, like on power plants and oil and gas production, as well as carbon credits. There's a carbon tax credit that's in process. It's still in the regulatory comment period, but I think you'll see that emerge with more rapidity. The big issue is, what is Biden going to do on fracking? Some people are convinced he's going to ban all fracking. Some people think he will narrow his ban on fracking to federal lands. And some people say he won't do it at all. Biden himself has been a little bit hesitant, a little bit quiet on the issue, and a little bit hesitant to say that he would ban fracking. I think what you also need to understand is the United States is not alternative energy ready. So if he were to significantly decrease the amount of oil and gas that is utilized for our economy, there's not a viable alternative yet. Plus, energy independence, which fracking helps us get, really impacts the global politics, which may play into the Biden administration. So I think a lot of the issues that we talked about is really just reinstating the pre-Trump rules that were gradually going to be put in place. And you need to think about, particularly there's a split Congress, these type of rules and rule changes take time. And so I don't think that we can pivot on a dime. Now, what about state level? I think you can see some state level regulatory regimes that'll kick in that are more pro-green, but I think that's going to be in a patchwork way. For example, in California, you have significant restrictions on fracking, but in Texas, you do not. And a lot of that is driven on the economy. Texas economy is very heavily focused on the energy space, and so the politicians know which side their bread is buttered on. But from a practical standpoint, for an energy transition to a green energy or alternative energy, you have to do that from a practical standpoint at the federal level, not a state level. So you may see some state level interfacing with respect to oil and gas, existing oil and gas, but a full transition will require more of a federal role. But at the end of the day, it is money and technology that's really going to drive that transition. And as Brad pointed out, a lot of the oil and gas, traditional oil and gas companies are moving very aggressively into alternative energies, be it battery production, EV, or whatever it may be. But I think at the end of the day, you're going to see a slower transition than some may hope, because that's going to be buoyed by the realities of the economy, et cetera. And you'll see a slower transition where you'll continue to have oil and gas, but I think you're going to see that oil and gas production to be on a cleaner, more cost-effective way, and a lot of money funded in for alternative energies.
Well, it'll be interesting to see what happens. There are a lot of uncertainties going forward in the new year. Artem, we have a question for you. The American shale E&P companies and the technology companies or the service companies have been amazing and in the forefront with technology, as you know. And that's allowed a substantial reduction in break-even prices for the wells, which has been some really good news. What are your thoughts now on what's going to happen in the future? Will we continue to see break-evens go down, or do you think we've pretty much come to the end of that process, if you will? Do you see other technology advancements on the forefront coming forward next year that would continue to increase the competitiveness of shale?
I would say we are still seeing continuous and structural improvement in typical economics of title producers. And, a lot of these improvements, they really come from the fact that the US industry has this very much unique feature. It has very long supply chain with so many participants. And the lower you are in this supply chain, the less pricing power you have. So when the market gets kind of oversupplied when there is a downturn, like it was in 2015 and 16 or 2020 this year. There is a continuous pressure on the suppliers and then on service companies to actually propose some new solutions. The most significant improvements in the economics, in the break-even prices, they have always been materialized during these downturns. Some people say that it was just a cannibalization of margins for service companies. To some extent, it was true in 2015 and 16, but some other things like continuous increase, continuous change and optimization of the well and project design, increasing the proppant intensity. Some of these things, they're still continuous trends, and operators, they keep adapting to the price reality which they observe in the current markets. Some technologies, some real technological breakthroughs, they are also happening. We're seeing continuous automatization in several segments of the industry. It helps to bring the cost down. There are some new completion methods like simul-fracs. They're being adopted by the industry only this year. And in many cases, operators are realizing significant cost savings on per well basis, basically the reduction in the unit well costs, especially when it comes to large scale developments with many wells on the same pads. So in my view, we'll keep seeing these gradual improvements in the well economics. This process is not really over yet, and the US title will become even more competitive in the global context in the next 2 to 3 years.
Another hot topic this past year has been the advent of the SPAC, the Special Purpose Acquisition Company. In all industries, I'm told, SPACs have been used quite a bit this year to raise capital instead of doing an IPO or some other more traditional method. And we've seen some SPACs in the energy space also. Keith, I'd like to talk about that with you and have your thoughts on SPACs as a capital raising idea for the upstream and the midstream, and how important do you think they will continue to be this coming year?
Yeah, that's a good question. It's been good to see that activity. There's been, no public equity market activity in the energy space. And so it's good to see some public equity activity that, is somewhat related to energy. There's been just an astounding amount of capital raised for SPACs this year. It's like $60 billion, which is a record. I think the previous record was $13 billion. So, they're at about 5x what the previous record was. There's only one oil and gas focused SPAC that we're aware of that has about $500 million to spend. There's actually one that an additional one that just went public named Breeze that just raised $100 million. And we know of 2 SPACs that were kind of watching that deal. It's a testament to where the market is for raising a capital inside a SPAC to focus just on traditional oil and gas acquisition. So we think there'll be 2 more coming now that we know. There's probably more that we don't know of. And so, maybe there's 5 to 10 that I could see, focused on oil and gas acquisitions, by say the end of the first quarter of next year. There's also been 13 raised focused on ESG, renewable alternative energy. We think some of those will also focus, as a subsector on oil and gas. And then there's 30 general, focused SPACs out there. And I think some of those will also have upstream oil and gas as a focus area. So I think it's a good thing. We have one of the SPACs in one of our A&D processes right now. And I think it's, they're potentially good buyer candidates. So I think it's a really good thing for the upstream oil and gas space, to have this type of capital come into the sector.
Brad, what about natural gas? Lately, natural gas has been the darling of everybody. We've seen the price finally begin with a 3 number. But then again, we're seeing predictions that the winter might be milder than usual. There's always a lot of factors driving the economics around natural gas. What are your thoughts on natural gas on the public equity front or for deals next year?
Well, Leslie, I think like a lot of these things, I think the timing on that, specifically is going to be tough to call. But I would say, generally speaking, there's a lot less headwinds facing gas stories than oil for the obvious reason. And you're right, as oil in the oil side of the equation fell into a tough market in 2020, particularly on the demand side of the equation, gas has certainly benefited to some degree. As we all know, the rig count for chasing oil has dropped dramatically throughout the year. And look, I would say that at the moment, the rig count chasing gas is about 25% of the total count. And I would say the last time that the gas rig count was that high was briefly in 2015, and then I think it was again in 2012. So, what's happened there is in the last 3 to 4 quarters, we have seen drilling and completion costs go down by 25 to 30%. And of course, gas is getting the benefit of that. So they're seeing their, economics or CapEx on the front end being reduced dramatically. Yet at the same time, the point that you just mentioned, we've had a, uplift in gas prices. As everyone knows, we were, mid, $1.50 to $1.70 in the middle of this year. And now we've been as high as $3. And I think we're at $2.70, $2.80 today. So I would just say that the economics associated with these gas stories have gotten a lot better. I would say that they are sustainable from our perspective. Even if gas does fall off a little bit, we still see a lot of activity, at the field level. The 3 basins, predominantly gassy, are very active at the moment, being financed by very good balance sheets. And so in terms of just a public deal activity in 21, again, that's going to be tough to call, but I would say that there's a lot of activity on the private side of the equation, and we hope that does drive activity, on the public side. So look, if the numbers and economics continue to play out in 21, I can see there being some appeal for either gas weighted IPOs or even secondaries associated with gas stories. And then, of course, as everybody knows, gas is cleaner than oil, and we see that fund managers that allocate capital across a variety of industries within conventional energy, gas is cleaner, and it's easier for these fund managers to dedicate capital to a natural gas story. So all that being said, we see momentum for sure picking up in 21 for gas, and we're hopeful that leads to some equity deals here in 21.
Paul, I'd like to come back to you for a moment and talk about private debt. In many cases this past year, private debt and alternative debt has stepped up to the plate when other forms of capital were not available. What are your thoughts on that topic and going into the new year?
Thanks, Leslie. So look, debt funding in the energy space continues to have a high bar. And I think at the end of the day, it really just boils down to, lenders ultimately want some certainty that they can be paid back the funds that they've ultimately lent to a particular borrower. And with the volatility that's, happened, I'd argue numerous times, through 2015 and 16, and then obviously, even more so this year in 2020, the number of lenders in the space has continued to decrease. I think ultimately, the way companies can best position themselves for 2021 is at some level they're going to have to develop new relationships. So the traditional senior lender that may have had a branch on the corner that they knew sort of from socially as well as from a business perspective is really no longer there, as a lot of senior banks have exited. So they're going to have to work a little bit to just develop relationships with these alternative lenders, institutional lenders that may be in other cities or just that they've not known before. And I think ultimately there's probably 3 key ways they can do that to really set themselves apart, right? It's they've got to be, sort of prove themselves to be operating a profitable business that produces free cash flow. And there's got to be a track record there. I think they have to ultimately minimize sort of the quantum of debt that's ultimately necessary. And what I mean by that is, and again, I'm really just going to speak from an oil field and midstream perspective and maybe leave the upstream to Keith or Brad. But from an oil field service perspective, limiting leverage to sort of 1 to 2 times is probably a realistic goal. And for midstream, maybe you get up to 3 times. But if you think back, sort of 12 to 18 months ago, it was not uncommon for midstream companies to borrow up to 5 times, total leverage. It's just in today's current environment with all the uncertainty that's been, significantly curtailed. And then probably the last thing would be just to figure out ways to set themselves apart from an operating model perspective, whether that's, becoming a market leader in their particular niche, whether it's honing in their services on niches that are, considered to be more defensible, and or just having sort of a better ESG, sort of reputation out there. All those things are going to be important as, these lenders ultimately take these opportunities and credits to their investment committees for approval, because a lot of these are just new boxes on the forms that they're going to have to check, and it's going to provide them the ability to check them and then ultimately, heighten or increase the probability that ultimate borrowers are going to be able to receive the funds necessary.
Holt, what about your thoughts on the legal aspects of the new debt world, we'll call it, the new debt world for upstream and midstream?
That's a good question, Leslie. As both Paul and Keith pointed out, starting in mid-2019, you saw most of the bank and lending institutions either limit the amount of exposure they had to the oil and gas sector or just decide that they're going to pivot out of that sector altogether. And so we think that banks are going to continue to hold that approach for 2021. And so we're seeing a number of different alternatives, and people in the private equity world are some of the smartest people in the industry, and they have lots of tools in their kit. The banks initially were asking for override royalty interest towards the end, throughout the process, but particularly towards the end of lending. So that was kind of an equity kicker. But as banks tend to exit, the ORI is not as viable of an option. Not as many people are looking for just that small tranche. Rather, you're seeing a number of other items. First, you're seeing net profits interest, which are analogous to override royalty interest, but you have exposure to management or costs. So it's a structured financing that has many more restrictions than override royalty interest and are much more complicated and tax driven. And it's when most of that money is going for the acquisition or the development of the assets, as opposed to just an operating loan or an RBL. They're unique, they're structured, they take a lot of time to do. And then once they're in place, it's very difficult to sell the assets by the grantor without a number of consents. And so you're seeing companies and private equity funds reach into their toolkits and doing a number of things. First, as Paul mentioned earlier, there's still a lot of roll-ups to save G&A. And so what a number of companies are doing is trying to preserve G&A and utilize that instead of something that they would typically look to debt financing to do. A lot of these private equity funds and other non-traditional lending sources, be it hard money lenders, private equity funds, family offices, or whatever you may have, a lot of them are coming to the industry and saying, hey, we will loan you money. And so you're seeing a lot of these companies issue debt in lieu of equity. But these debt products are structured like equity. The economics are more similar to what an equity investment might have been the year before. But the beauty about it is that because it's debt, you can get a security interest in the asset and you have priority over the equity. So I'm seeing a lot of that. I'm seeing preferred equity with assets being down. Some people who are bullish on the long term of energy are stepping in because they're getting assets that you may have up to $1 billion invested, but you're getting preferred equity at a valuation that is literally pennies on the dollar. And so you're able to kind of prime the existing, not only are you able to prime the existing common, but you're coming in at a significant pro-lender valuation or pro-preferred equity valuation. The nuance is if you're trying to bring in a new management team to manage those assets, or if you're trying to keep a good management team that just happens to be a victim of a bad economy, what do you do with their incentive units, and how do you ratchet their incentive units down so that they kick in at the lower valuations without making the original equity providers feel like they've been shortchanged? I am even seeing some real creative things such as seller financing. People want to get, you're seeing some people say, I want to exit these assets or I want to exit this industry. And so I am willing to, if I can get money now that I can put on my books and make a distribution, even if it's an ultimate loss, but a distribution to my investors, I am willing to take a slug of money up front and even do a seller financing over the next 1 to 5 years, which is something crazy you wouldn't have seen beforehand. We're also seeing IUs, incentive units for capital providers. Hey, if you come in for a preferred or a debt instrument, if we meet a certain threshold, if we have a home run, then I'm going to give you an incentive unit or profits interest to the lender or the equity provider. So it's really interesting to see all the creative options that are out there. I think that companies are realizing that the banks are kind of closed for business, and so it's kill or be killed, and they're being very creative. And it's amazing that I think that there is an appetite for these opportunities, not general, but specific. And there could be some big transitions in wealth as a result of it.
Let's turn to another topic, which has been a hot one this year, and that's restructurings. We've seen a great deal of movement in restructuring of a lot of companies, up to and including out-of-court bankruptcies and in-court bankruptcies. Keith, I'd like to know your thoughts on that, where we go from here, if that sort of level of activity is going to continue.
Yeah, I think it will, continue at least for, call it, the next 6 months or so. I think until, demand comes back, there's just still a lot of heavily levered companies out there that are in challenged situations. There have been a lot of bankruptcies, like you mentioned, and those companies have emerged with better balance sheets. And so I think they're in pretty good shape, but there's a lot of high yield issuers out there that really, have maturities coming due. And there's just no high yield market for them to refinance into. And so those companies are pretty challenged right now. I think also with the banks, I think generally the banks kind of kick the can down the road in the spring, hoping there'd be kind of, a quick recovery out of COVID. That didn't happen. We're now in the November borrowing base redetermination season. There could be some restructuring activity coming out of that. We do have kind of a light at the end of the tunnel now with all this positive vaccine news, but I think some companies aren't going to be able to make it, until demand returns. It takes, a while for demand to return. And so, I do think there's going to be, a continued high level of restructurings, at least for the next, 6 to 9 months.
Well, it's unfortunate that companies have to go through that, but in the end, the industry as a whole, I think, ends up healthier. Let's get back to talking a little bit about the ramifications of the election that I guess we're still officially waiting for the result here. Paul, I'd like for you to start, if you would please, with your thoughts. With the Joe Biden presidency, I think we talked about this a little bit before, but do you anticipate some meaningful changes that would impact the energy space, whether it's upstream or downstream or midstream, whatever? Love to hear your thoughts. If there's, for example, if the Senate becomes truly Republican majority, or if it becomes Democratic, maybe a tie, what do you think?
Yeah, look, to me, Leslie, that last statement's probably the bigger question, right? Joe Biden presidency, I think ultimately will have, some risks and some rewards. But I think people in the industry feel reasonably comfortable that as long as the Senate remains in Republican hands, there's at least some sort of check or balance to maybe a more radical agenda that is more detrimental to energy overall, i.e., an acceleration of the Green New Deal and all the things that would imply. Look, to me, there are some benefits of Biden potentially getting in, right? We've talked about it. With what Biden has proposed, or at least seems like he could propose to do, it may limit activity overall, but, at the end of the day, it likely increases, commodity price. And to me, in my opinion, what's the best for the industry overall is, one, they just need to know the rules, right? So what are the new rules of the road that they need to play under? And then two, commodity price has to be at a level that ultimately is, they deem to be sustainable to continue with levels of activity. And I do think if, commodity prices get to 50, 60, $70, that's going to be good for the industry overall. Again, may not produce as much oil and gas, but the industry will be profitable, it will be healthy, it will be attractive. And to me, that's probably the biggest thing. The other thing I'll just touch on for a minute is just, again, the whole ESG dynamic and the fears that, Biden's going to impose, something overly restrictive on the industry. It's been pretty good about policing itself in terms of being a good corporate steward, which ultimately ties into ESG. And to me, ESG is similar to sort of the social safety dynamics that the industry self-imposed upon itself a number of years ago. And so the industry's taken a lot of steps to, again, cut emissions, do things more efficiently, have a less of a carbon footprint, all those sorts of things. And so whether or not Biden ultimately imposes more restrictions on that or not, to me, the industry's already somewhat doing it on itself. And so hopefully it's not that big of an impact overall if you sort of think through it and see the ultimate end game.
Keith, how do you think this new administration would affect investment banking in particular, affect your ability to do deals, M&A, or equity raising or debt raising, whatever?
Yeah, that's a good question. I think, there's a lot of different ways to answer that. I think fortunately for us, we aren't kind of a one-trick pony. So, we do deals in the public equity space, the private equity space, the restructuring area, private debt, M&A, A&D. And it's just always been that one or two of those product areas is always, going strong or relatively strong while the others slow down. So, this year is very challenging, and we've had a good year because we've worked a lot on restructurings, and mostly restructurings, but A&D. If we were just beholden to working on public equity deals, I'm not sure any of us would have jobs. But so fortunately, we can kind of hop around to the different product areas, and so our mix of business will change, and I think that's both within Stephens and I think within investment banking generally. But I don't think the overall level of volume, will go down to a point where it hurts us. Like that, like what happened this year. But I think specifically, I could see, if prices go up, maybe public equity activity picks up a little bit. If commodity prices go up, maybe that picks up a little bit. Maybe corporate M&A activity. I think that's going to probably be relatively strong anyway. If it doesn't pick up, restructurings will be strong. And then, private equity, there's always private equity deals. There's bottom fishers out there in tough times. They're looking for deals. Maybe the sources of those deals aren't really traditional private equity groups as much going forward. Maybe they're more high net worth groups, but there's definitely going to be, private equity deals to be done. So I think, we're not too concerned about it. We're just trying to figure out which product area is going to be, kind of our areas of focus next year.
Artem, we haven't heard from you in a few minutes here, but I'd like to ask you, Rystad has so much data and perspective. Assuming that we get this COVID vaccine dispersed to people, I'm seeing in the news that maybe by mid-year, more and more people will have gotten the vaccine. So that begs the question, what about the recovery of the economy in general, and therefore the recovery in energy? What are your latest thoughts on the recovery?
I would say, a few months ago, many people were saying that it would be a W-shaped recovery. And I think now we're really heading towards the environment where another market crash is not impossible, at least before we really get to the structural recovery phase. And I think the market volatility will remain pretty high in the foreseeable future. When it comes to the oil industry specifically, we have two sides of the equation. We have demand and we have a supply story. And then on the demand side, even in the most optimistic scenario, we see global liquid consumption averaging at 97, 98 million barrels a day next year, which is basically 2 to 3% below of where we were in 2019. But as I said, this is really the most optimistic scenario where so many different things have to contribute to the demand positively in the same direction. Most likely will average somewhere in 95 to 96 million barrels a day range. In particular, aviation, the jet fuel consumption, this is the segment which is lagging behind on the recovery side. And even if you vaccinate the whole world, there will be some structural behavioral shifts. And we think people just won't travel as much as they did previously. So it will take several years for the airline industry to truly recover to pre-COVID levels. And then on the supply side, I would just list three main factors which we should all watch. First of all, we shouldn't forget about the uncertainty around the US oil supply. We feel there is quite strong consensus about 2021 right now, but we need to remember that the US oil industry has a very long track record to outperform consensus estimates on the production side. Maybe we're not talking about the same magnitude of outperformance as we saw in 2018, but we might get some positive surprises. Well, positive for the US production, but it will be negative for the global supply-demand balances. Then we have Libya, which came back very quickly. There is some speculation these days. The government of Libya, they have already announced that they returned to 1.2 million barrels a day. Some people don't believe it. I could tell you that we monitor gas flaring in Libya with satellite data near real time, and it's almost back to the level where they were when they were producing 1.2 million barrels a day. So it is very likely that they returned at least close to this production level. But to maintain this production level next year, this actually will require them to invest quite a lot because a lot of damage has been made during the shut-in phase. And then finally, it is OPEC Plus strategy and behavior of some key members. In our view, OPEC Plus actually needs to extend the cuts at least 3 to 6 months in 2021 at the current level. If they really go back to from 8 to 6 million barrels a day cut already from January, any demand weakness can send oil prices back to low 30s probably in the short term. So in our view, it is very likely that we'll actually agree on extending the cuts a little bit longer, and this will help to support oil prices probably in mid-40s in the foreseeable future. And then just one quick comment about the longer-term perspective. I would say that we are almost confident that there will be at least another upcycle for the oil industry before the global liquid consumption peaks structurally. Most companies, they revised their long-term oil consumption peak. They moved it closer in time. We now see global oil consumption peaking somewhere at 102, 103 million barrels a day in late 20s. But the actual dynamics is very complex and it really depends on the segment. The most significant structural changes is happening within the transportation segment, specifically light duty vehicles, where we see a rapid penetration of EVs as we move towards 40s. It will take a little bit longer for trucks and buses to see full adoption of EVs. So global oil consumption in this segment will continue growing into mid-30s. Petrochemicals will probably grow, through late 30s, and then we will have aviation where the growth will probably persist through 40s or 50s from mid of 21st century. But even with all this growth in the medium term, we have all other smaller segments which combine account for around 25 million barrels a day of oil consumption. It's agriculture, buildings, industry use, power segments, energy own use, and non-energy use. And these segments, they have been declining structurally since 2010. And the growth we're getting from all biggest segments is hardly sufficient to replace the decline from these smaller segments in the foreseeable future, which is why we don't anticipate that the long-term peak in oil consumption will be much higher than the pre-COVID consumption record.
Holt, with all of that we've seen and heard today, what are your thoughts, parting thoughts on the new year and how all these trends may play out from a legal point of view?
I'm optimistic. I mean, it would be depressing to say otherwise, but I think that you've seen a transition as the year has progressed where I think people are starting to have a little bit more faith in the economy. I think some of the concerns about politics and who the next president's going to be has resolved themselves. I think while there's still a separation between the bid ask, I think that people are starting to get comfortable that maybe there's not a falling knife. And I think creativity is going to be rewarded. I think patience is going to be rewarded. But as money moves out of the industry, I think that's going to create opportunity for those that are willing to put money in, and hopefully we can all participate in that.
Brad, if you would kick off, what is the recovery view for 2021 from the point of view of Stephens?
Well, look, we agree with everything that Artem and his firm are saying. And of course, we're reading a lot of the data and numbers that Artem and others are publishing. And I would say we generally agree with everything that he has said. And, looking at the last two down cycles that we've come out of, one a decade ago, being the credit crisis, and then, 14 through, mid 16, coming out of those two down cycles, the recoveries were pretty robust, fairly rapid. And I think that after a little bit of a healing period, you saw capital being deployed at a pretty quick rate. Look, I would just say that our view at the moment is that we are cautiously optimistic. We feel like there will be a recovery, albeit methodical and cautious. Coming out of the credit crisis and then coming out of 14 through 16, you still had quite a bit of capital net coming back into conventional energy. And I think the difference today is you've got quite a bit of capital either sitting on the sideline, not quite sure if they want to get back into conventional energy or not. Of course, we've all talked about ESG and capital going into renewable strategies, and that is, certainly competes for capital from conventional, activities. So, look, I just would say that we're cautiously optimistic. I would say that gas will probably recover quicker than oil based on what we've previously discussed. But that's kind of our stance at the moment.
All right, thank you so much. That concludes our webcast today, and I want to thank all of you for joining in. It's been a fascinating conversation, and I hope that your views on optimism pan out, that the next year will be better for all of us. Thank you again to the Stephens Energy Investment Banking team. And thank you for watching today. I'm Leslie Haynes, Oil and Gas Investor Magazine, Executive Editor at Large. Thank you and have a great day. Goodbye.
Stephens, an independent financial services firm, has a long history in the energy markets and is highly regarded for its sector expertise and prudent client advice. Over the past decade, Stephens has continued to affirm its industry focus, growing its dedicated investment banking team to 15 professionals and completing 167 transactions to date. The group's coverage includes the exploration and production, master limited partnerships, oil field services sectors, and energy infrastructure. The combined knowledge of the energy team enables Stephens to provide clients an unmatched level of investment banking service, including mergers and acquisitions advisory, fairness opinions, and public and private debt and equity offerings.